Hello, I'm John A.G., and I want you to imagine a moment where nothing dramatic seems to be happening, yet something inside you quietly realizes that the floor you're standing on isn't as solid as it felt yesterday. Not cracked, not collapsing, just subtly unstable, the way a building feels moments before anyone notices it's leaning. That feeling is uncomfortable because it doesn't come with a clear headline or a single event you can point to. It comes from recognizing that a system you trusted is behaving in a way it never has before, and that the explanations being offered don't quite match what your intuition is telling you. That realization is where we need to begin, because what unfolded between Wednesday morning and now isn't just market noise. It's the kind of signal that only appears when confidence itself starts to thin out. Most people are taught to think of markets as machines that correct themselves. Prices go up, prices go down, and volatility is framed as something healthy, even necessary. When losses happen, we're told it's profit-taking, a rotation, or an overdue pullback after excess optimism. That framework is comforting because it suggests order, a kind of natural rhythm that always resolves back into stability. But every so often, markets don't move because they're correcting excess. They move because belief shifts. And belief, once it starts to move, doesn't follow neat technical patterns. It moves in waves, unevenly, often triggered by events that look unrelated on the surface. This week looked, at first glance, like one of those ordinary storms. Stocks fell hard, precious metals spiked and then dropped violently, the dollar weakened. Commentators rushed in with familiar language, calling it a correction, a repricing, a reaction to policy uncertainty. That language matters because it's part of the false comfort trap. It reassures people that what they're seeing fits within known boundaries, that nothing fundamental has changed. But when you step back and look at the sequence, the timing, and the scale, something feels off. Corrections don't usually arrive alongside public doubt about sovereign debt from foreign institutions. They don't usually coincide with record-setting commodity moves and abrupt currency weakness at the same time, and they certainly don't happen when the underlying fiscal math is already stretched beyond anything seen before. Let's ground this in what actually happened. On Thursday, one of the most valuable companies in the world lost hundreds of billions of dollars in market value in a single session. That's not unheard of in percentage terms, but the absolute scale matters. This wasn't a fragile company or a speculative corner of the market. It was a core pillar of global equity portfolios. At the same time, gold reached a price never seen in recorded history, reflecting a sudden surge in demand for something perceived as outside the currency system. Then, within hours, that same gold price collapsed as leverage positions were forced to unwind. Silver followed, dropping at a speed that erased years of gains in minutes. None of this was driven by changes in mining supply or industrial demand. It was driven by positioning, leverage, and most importantly, stress. Stress doesn't show up first where people expect it. It shows up where assumptions are thickest. Precious metals are often treated as sleepy, long-term hedges, not instruments of violent intraday swings. When they start behaving like high beta risk assets, it's a sign that something deeper is being repriced. Add to that a sharp move in the dollar against other major currencies, and the picture becomes harder to dismiss. Reserve currencies don't typically move that fast without a reason, and when they do, it's rarely about short-term sentiment alone. Here's where the early value reveal comes in, because there is one real mechanism you need to understand before anything else makes sense. Modern financial markets are built on leverage layered on top of confidence. Leverage amplifies returns, but it also amplifies doubt. When prices move against leveraged positions, margin requirements increase, forcing liquidations. Those liquidations don't care about long-term value or fundamentals. They care about cash, immediately. That's why assets that people think of as safe can suddenly fall alongside everything else. It's not because they've lost their role. It's because the plumbing of the system demands liquidity first and explanations later. This is why the sequence matters. A spike in gold suggests a flight from currency risk. A sudden crash in gold immediately afterwards suggests forced selling, not a reversal of that fear. Those two things together tell you that stress is building beneath the surface. They tell you that people are trying to move towards safety at the same time the system is forcing them to sell whatever they can. That tension is not sustainable, and it rarely resolves quietly. Now, there's a larger risk here that doesn't reveal itself all at once, and this is where most people stop paying attention. They see volatility and assume it will pass because it always has before. What they miss is that volatility tied to leverage can act as a trigger rather than an endpoint. It exposes where confidence is thin and where assumptions are fragile. When those assumptions involve government debt, central bank credibility, and the long-term value of currency, the consequences extend far beyond a few bad trading days. To understand why this matters, you have to step out of the present moment and look backward, not for dramatic collapses, but for patterns. History doesn't repeat in details, but it repeats in structure. Whenever a dominant power controls the system everyone else relies on, whether that system is trade, money, or finance, it moves through phases. The first phase is built on genuine strength. Productivity is high, institutions are trusted, and the medium of exchange represents real value. People don't question it because it works. Trade flows through it naturally, and holding it feels safe. Over time, that success creates temptation. Control over the system makes it easier to promise more than can be delivered. Spending grows faster than revenue, but instead of confronting that gap directly, it's papered over. New money is created, new claims are issued, and the difference is pushed into the future. Because the system is dominant, the consequences don't show up immediately. They're spread across everyone who uses it. This phase often feels like prosperity. Living standards rise, markets expand, and confidence deepens, even as the underlying math quietly worsens. Eventually, though, there comes a point where the numbers can't be ignored. Debt grows faster than the capacity to service it. Interest costs consume resources that once funded growth. Foreign holders begin to notice that what they're holding is being diluted. Confidence doesn't vanish overnight. It cracks, first in private conversations, then in cautious policy statements, and finally in public actions. This is the crisis phase, the moment when belief starts to fracture, but the system is still intact enough to function. What makes this phase dangerous is that it's often misread. Because the system hasn't collapsed yet, people assume it won't. Because interventions have worked before, they expect them to work again. But history shows that once this phase begins, it doesn't reverse on its own. It either transitions into a new structure or breaks under its own weight. The timing is unpredictable, but the direction isn't. That's why what we're seeing now feels different. The scale of borrowing, the pace of debt accumulation, and the growing tension between political pressure and monetary policy aren't abstract concerns anymore. They're starting to intersect with market behavior in visible ways. When foreign institutions openly question the wisdom of holding government debt, that's not routine. When central banks pause, hesitate, or appear constrained by politics rather than economics, that's not business as usual. And when markets respond across multiple asset classes at once, it's a sign that the denominator, the unit everything is measured in, is being reevaluated. We're not at an ending yet. Systems don't disappear in a week. But we may be at a point where the way people think about safety, stability, and value begins to change. That change doesn't announce itself with sirens. It shows up as discomfort, as volatility that doesn't quite behave the way it used to, as explanations that feel thinner each time they're repeated. And once that shift begins, the next phase isn't about prices alone. It's about how people redefine what they trust, what they hold, and what they expect the future to look like. If part one unsettled you, that's intentional, because the next step is understanding why the discomfort isn't an emotional reaction, but a rational response to incentives quietly shifting. Systems don't fail when people panic. They fail when incentives no longer align with trust, and right now those incentives are moving in ways most people aren't watching. The comforting story says this is just another cycle, that central banks will smooth things out, that political noise fades and markets stabilize. That story has worked before, which is why it's so persuasive. But stories only work as long as the math behind them still holds. The math is where the false comfort trap collapses. Governments can run deficits for a long time without visible consequences when growth is strong and interest costs are manageable. The illusion of sustainability comes from the gap between cash flow and reality. As long as borrowing feels cheap and demand for debt remains high, the system appears stable. But stability here is conditional. It depends on confidence that future productivity will be sufficient to service today's promises. When that confidence weakens, even slightly, the entire structure becomes sensitive to shocks that once would have been absorbed quietly. This is why the pause in monetary policy this week mattered more than any single market move. A pause isn't just a decision, it's a signal about constraints. It says inflation hasn't been fully subdued, even after years of tightening. It says there's limited room to maneuver without risking either growth or credibility. When political pressure enters that equation, openly and publicly, it introduces a new variable: doubt about independence. Markets don't need proof of interference, they react to the possibility. Independence is valuable precisely because it removes suspicion. Once suspicion appears, even if nothing has changed operationally, trust erodes. Trust erosion rarely looks dramatic at first. It shows up in small reallocations, hedges layered on top of existing positions, and quiet conversations among institutions that manage very large pools of capital. When those conversations become public, as they did this week, it marks a shift from private concern to collective awareness. That's when the awakening phase accelerates. It's not that everyone suddenly agrees the system is broken. It's that enough participants begin acting as if protection is necessary. History helps here, not as a warning of collapse, but as a guide to behavior. When the Roman monetary system began to deteriorate, people didn't abandon it overnight. They accepted debased coins at face value until prices adjusted. Then they started preferring older coins. Eventually, they demanded payment in goods. Each step made sense individually. Together, they transformed the economy. No single decree caused the shift. It emerged from countless rational decisions made under uncertainty. The same pattern appears in modern examples. In early stages, inflation is dismissed as temporary. Wage increases seem to keep up, asset prices rise, and debt feels manageable. Then inflation persists longer than expected. Interest costs grow. Debt rolls over at higher rates. Suddenly, resources that once funded growth are diverted to servicing obligations. That diversion isn't visible on a single day's chart, but it compounds relentlessly. At some point, the question changes from, can this be managed, to who bears the cost? That question is where second-order effects emerge. Policymakers don't respond to debt stress by admitting insolvency. They respond by shifting burdens. Taxes rise in subtle ways. Inflation is tolerated as a silent reducer of obligations. Regulations change to encourage or force demand for government debt. Each response buys time, but introduces distortions. Those distortions alter behavior. Investors shorten time horizons. Savers look for alternatives. Institutions diversify not because they want to, but because concentration becomes risky. This week's market behavior reflected those second-order effects. The sharp liquidation across assets wasn't a verdict on individual companies or commodities. It was a response to funding stress. When leverage unwinds, correlations spike because everything is measured against the same unit. That's why assets that are supposed to protect against currency weakness can fall temporarily during crises. It's counterintuitive, and it's why people misinterpret early signals. They assume protection failed when in reality it was postponed by forced selling. The mid-video cliffhanger, the moment where perspective shifts, lies here. If you believe safety is defined by price stability alone, recent moves look chaotic and contradictory. If you understand that safety is defined by long-term purchasing power and control over real resources, those same moves look like the opening phase of repricing. The question stops being, why did this asset fall, and becomes, what is being repriced against what? Consider the scale of obligations now embedded in the system. The national debt didn't grow by accident. It grew because each incremental increase felt manageable. Borrowing $8 billion a day sounds abstract until you realize it compounds regardless of market sentiment. Interest costs consuming more resources than core social programs isn't a theoretical future. It's current reality. When servicing debt becomes one of the largest line items, flexibility disappears. Choices narrow. Policy becomes reactive rather than proactive. Reactive policy has consequences. Attempts to stimulate growth through spending increase debt. Attempts to control inflation through tightening raise servicing costs. Attempts to do both simultaneously strain credibility. Markets sense this tension long before it's acknowledged officially. That sensing shows up as volatility, currency weakness, and sudden shifts in asset preference. None of these alone signal collapse. Together, they signal transition. A practical reframe begins with abandoning the idea that stability means prices staying within familiar ranges. Stability, in historical terms, means systems adjusting to new constraints. For individuals, that means understanding the difference between nominal values and real ones. A portfolio can appear stable in nominal terms while losing purchasing power quietly. Conversely, it can appear volatile while preserving or even increasing real value over time. Another mental model that matters is liquidity versus value. Liquidity is the ability to transact quickly. Value is the ability to store purchasing power. In stressed systems, liquidity is demanded first, often at the expense of value. That's why forced selling happens. But once liquidity needs are met, capital flows back toward value. Understanding that sequence prevents emotional reactions to temporary price movements. It also helps to think in terms of claims versus control. Holding currency or debt is holding a claim on future output. Holding productive assets is closer to holding control over that output. When systems are stable, claims and control feel equivalent. When systems strain, control becomes more valuable than claims. This shift doesn't require collapse. It only requires uncertainty about fulfillment. Uncertainty is rising because confidence is being tested on multiple fronts at once. Fiscal sustainability, monetary independence, geopolitical alignment, and demographic pressures are converging. Each alone would be manageable. Together, they create a backdrop where reassurance sounds less convincing. That doesn't mean catastrophe is imminent. It means adaptation is necessary. The unsettling part is that adaptation isn't evenly distributed. Those with flexibility, diversification, and understanding adjust quietly. Those without remain exposed to the assumptions of the old framework. This divergence is how wealth transfers occur without a single dramatic event. It's not a sudden wipeout. It's a gradual reallocation that accelerates when confidence breaks more visibly. As we move forward, The key isn't predicting the exact trigger or timing. It's recognizing that the system is entering a phase where old rules produce diminishing returns. Watching how policymakers respond, how foreign holders behave, and how markets treat traditionally safe assets will offer clues. The real question isn't whether change is coming, it's whether you're interpreting the signals through outdated assumptions or updated ones. Because once perception shifts broadly enough, the final phase doesn't announce itself as an ending. It arrives as a new normal that makes the old one feel impossibly distant. By the time a system reaches this point, the conversation usually shifts in a subtle but dangerous way. People stop asking whether the structure itself is sound and start arguing about which lever might restore confidence. One group insists growth will solve everything. Another argues austerity. Others place faith in innovation, new technologies, or new political leadership. These debates feel productive, but they often miss the deeper issue. They assume the problem is one of management rather than structure. History suggests that once a reserve-based system enters this phase, management tweaks don't reverse the trajectory. They only influence who absorbs the costs and how quickly the transition unfolds. This is where the final phase begins to take shape, not as a single event, but as a gradual redefinition of what money, safety, and value mean. Stage 4 is often misunderstood as sudden collapse, but more accurately, it's a reset of reference points. The unit people once trusted becomes less central. Alternatives don't need to be perfect. They only need to be perceived as relatively safer. That perception alone redirects flows of capital. Over time, those flows solidify into a new structure. In previous transitions, this didn't require chaos. Rome didn't fall the day its currency lost credibility. Britain didn't cease to function when sterling lost reserve status. Life went on, trade continued, but the rules changed. Those who held assets aligned with the old system experienced a slow erosion of purchasing power that felt confusing and unfair. Those who held assets aligned with real production, scarce resources, or the emerging system found themselves relatively insulated, sometimes even advantaged. What makes the present moment distinct is the speed at which information travels and decisions propagate. Confidence can shift globally in days rather than decades. Capital moves faster than ever, and leverage magnifies both optimism and fear. That doesn't mean outcomes are predetermined or immediate, but it does mean transitions can compress in time. The early signals we're seeing now would have taken years to become visible in earlier eras. This is why understanding the mechanics matters more than reacting to headlines. When gold surged to historic levels and then fell sharply, many interpreted that as failure. In reality, it was a demonstration of stress. The surge reflected a desire to escape currency risk. The fall reflected the system forcing sales to satisfy leverage. Both can be true at the same time. Interpreting one without the other leads to false conclusions. The same applies to equities. Large, profitable companies losing massive market value in short periods doesn't mean their productive capacity vanished. It means their valuation, expressed in a stressed currency environment, is being repriced. In transitions, prices don't move solely on earnings expectations. They move on confidence in the measuring stick itself. When that measuring stick wobbles, everything measured by it appears unstable. A practical way to think about this is to separate volatility from vulnerability. Volatility is movement. Vulnerability is exposure to permanent loss of purchasing power. Highly volatile assets can still preserve value over long periods if they're tied to real demand or scarcity. Seemingly stable assets can be vulnerable if their stability depends on a currency that's being diluted. This distinction becomes critical in late cycle environments. Another useful frame is to look at who is forced to act versus who has optionality. Forced actors, leveraged traders, institutions bound by mandates, governments constrained by politics, react under pressure. Optional actors, those with flexibility and low leverage, can wait, observe, and reposition. Historically, wealth transfers occur when forced actors sell to optional ones. The transfer isn't announced. It's embedded in transactions that feel routine at the time. As the system continues to adjust, expect contradictions. Policies designed to support markets may weaken currencies. Efforts to control inflation may strain growth. Attempts to stabilize debt markets may increase long-term obligations. Each action solves one problem while exacerbating another. This isn't incompetence, it's constraint. When promises exceed productive capacity, trade-offs become unavoidable. Over the next phase, watch behavior more than rhetoric. Watch whether foreign holders continue to reduce exposure. Watch whether long-term interest rates respond to policy guidance or ignore it. Watch whether real assets maintain demand despite price swings. These behaviors reveal confidence levels more accurately than official statements. Confidence once lost is difficult to restore because it's based on expectation, not decree. For individuals, the goal isn't prediction, it's resilience. Resilience comes from aligning with what persists across regimes rather than what thrives only under specific conditions. Throughout history, certain things have proven durable: control over resources people need, claims on productive activity rather than promises, and skills that remain valuable regardless of currency. These elements don't eliminate risk, but they change its nature. It's also important to recognize that transitions are uneven. Some regions adapt faster, some sectors benefit while others lag. A reset doesn't distribute outcomes equally or fairly. It rewards awareness and flexibility. That can be uncomfortable to acknowledge, but ignoring it doesn't change the result. Understanding it at least offers agency. As this phase unfolds, narratives will harden. Some will insist nothing fundamental is wrong and that skepticism itself is the problem. Others will predict immediate catastrophe. Both extremes miss the nuance. Most historical transitions occupy a middle ground where systems function, but under new rules that gradually become apparent. Those who expect either instant collapse or a full return to the old normal are often the most surprised. The unsettling question, then, isn't whether the system will survive. Systems always survive in some form. The question is whether the form it takes preserves the value of the claims you hold. If money is a claim on future productivity, and that claim is being diluted, what does that imply for long-term planning? If reserve status confers privilege, and that privilege is eroding, how does that reshape incentives globally? We're living through a moment where these questions are no longer academic. They're being priced, debated, and hedged against in real time. The events of this week weren't a conclusion. They were a signal that the assumptions underpinning decades of stability are being revisited. Signals don't tell you exactly what will happen next. They tell you that paying attention matters. So the final question isn't about markets or policy or even money. It's about awareness. When patterns repeat across centuries, across empires, across technologies, ignoring them doesn't make you safer. It makes you reactive. Understanding them doesn't guarantee success, but it does change the odds. As confidence continues to shift and the system adapts, the most important decision isn't what you buy or sell on any given day. It's whether you're still measuring reality with a ruler that no longer holds its shape.